Hello, everybody, and welcome to today's podcast and webinar that we bring you here today. My name's Matthew Weiss. I'm the Commercial Director of Bench and the founder of the Africa Hospitality Investment Forum, otherwise known as AHIF. Before I hand over to Stephen Rushmore, the President and CEO of HVS, to introduce himself and the panelists today, I just wanted to say or inform you or tell you a little bit more. For those that don't know us, which I think there is quite a few in the audience, AHIF is an annual meeting place that takes place in Africa and brings together the likes of hotel owners, investors, developers, the financiers, the operators and the advisory firms as well, to come together and to do business and to find out more about what's making the market tick. This webinar is a small taster of what you would expect at any one of our events. And the next one will be in Namibia at the end of June. So hoping to see you all there. The event itself will bring together over 500 attendees to do more of this, to learn more about the trends and the opportunities that there are for hotel developments across Africa. So if you like what you see and hear today, then please check us out on www.ahif.com and we'll see you in Windhoek, I hope. So without further ado, I'd very much like to invite Stephen to come and introduce himself and the panelists today. Thank you for your time.
Thank you, Matthew. Hello, everyone. My name's Stephen Rushmore, President and CEO of HVS. I have an American accent, but I'm based in Cape Town, South Africa, I think one of the most beautiful cities in the world. And for those of you who are not familiar with HVS, we've been operating for well over 40 years. We're a hotel consulting firm, and we offer a number of professional services within the hospitality industry all over the world. But we're particularly good at forecasting how a hotel, an existing hotel or proposed hotel, will perform in the future. And we do that. We have 50 offices. We do that at least 4,000 times every year for various clients. So it's a little background on myself. I'd like to start off by saying thank you all for showing up here today and submitting your questions. As you know, Africa is a large continent, 54 different countries, and there's a lot that we could talk about here. We could easily spend a day or two talking about various hospitality-related matters. But we really wanted to respect your time. And so we've curated this entire program around the questions that you've submitted. And you've asked some actually very good questions and compiled them all a couple days ago. And we're going to, myself and well, particularly the panelists, are going to address every one of them. And for those questions that you've may have submitted more recently or can think of or submit using the chat function here, we'll try our best to get it here. We'll try our best to address it here during this webinar, or we'll get in touch with you at some point in time in the near future. If you can actually open up the screen that I have there that I'm sharing, my PowerPoint would be great. Go, perfect. So yeah, we received dozens of questions, and I've organized these questions into the following different categories, and it really flows into the life cycle of a hotel, and that's the format that we're going to use here today. So we'll start off. Rishabh, who's our panelist from HVS, our director in Middle East and Africa. We'll talk about investment opportunities and the current valuation parameters. So what markets are hot? What markets do you think have, or countries have growth potential? and go into some of the minutiae on the valuation parameters. And then we'll have a whole discussion with our broader panelists on development strategies. There's a number of questions submitted about should you build or should you buy? And then received a number of questions as well about financing. How do you find money for a project? And we actually have quite a number of attendees here who are not based in Africa. The data showed that 50% of the people here today are not located within the African continent. So it's understandable that you would have questions on how do you find money to move forward with a project. And then we have a number of questions about specific geographies, whether it be cities or markets or countries that we'll address head on. And then lastly, as part of the life cycle of a hotel, you want to sell a property, and what's the liquidity like? How easy is it to dispose of a hotel, and how common are transactions? So that's the general framework for which we'll be covering this webinar. We have a diverse panel of panelists joining here today, which will take a minute to introduce each of themselves. We have owners, we have people who are working for management companies, we have lenders, and really have representation throughout the African continent. So we'll start off, Khalil. If you can, we can get Khalil on the screen there to introduce yourself. Hello. And if you can spend a minute or two just talking about yourself, where you're based out of, if you are on the ownership side, the management side, the finance side, and about how many projects are you currently dealing with in the hospitality industry?
Okay, thank you very much, Stefan. Nice to be here, and again, thanks for the invitation. It's always a pleasure to share our journeys and experience and cases that we've been working on or closed on the African continent, and more specifically on the hospitality sector. So basically, I'm the founding president and CEO of Capital of Africa, which is an independent advisory boutique specialized in assisting sovereign state enterprises, companies, but also private investors looking into setting up and structure the funding of a infrastructure project as a whole in Africa, including, of course, the hospitality asset class, which is something that is growing more and more in the continent. So our job is, of course, to help our clients who are either investors or local developers, to bring them from an idea to a closed transaction in up and running project that ultimately will make money. So I'm based in Dubai, and I'm spending a lot of times on the ground in Africa, working with investors, institutions, and also in some cases some high net worth individuals looking to develop some long run yielding assets such as hotels in across the continent.
Okay, thank you for that. So development all across Africa, with hospitality being one of several different types of verticals that you're involved with. Great.
Exactly.
Thank you. Amr, we can bring up Amr on the screen here. Hello.
Hello. Hi, Stephen. Hi, Khalil. Hi, Rishabh.
Hi, Amr.
Tell us a little bit about yourself.
Sorry, come again, Stephen. You've been cutting.
Yes, tell us a little bit about yourself. Your what company that you work for? Are you on the ownership side, the management side, the lending side, and what's your geographical scope?
Sure that. So I'm honored to be the CEO for the Real Estate and Tourism Subfund at the Sovereign Fund of Egypt. The fund has current AUMs north of $2 billion in the real estate and hospitality avenues, out of which one single investment is $350 million in Legacy, which is a major hotel owner that owns 7 legacy hotels, including the Mena House, Marriott, and the famous Zamalek Marriott, and the Old Cataract and Winter Palace in Luxor and Aswan, and the property in Alexandria, the Sicil. All properties are legacy historic hotels. We, as the Sovereign Fund of Egypt, act as a private equity fund of funds, whereby the main fund hosts the talent and investments in sub-funds, one of which that I had is the Real Estate and Tourism Subfund. We have some very good opportunities in terms of the fact that the government transfers the ownership of assets that are unutilized, that are historic assets, to the fund as a subscription into its capital to be utilized through creating partnerships with private sector investors and foreign investors. We have 2 properties in the pipeline, so we're doing an autograph collection by Marriott, the first in Cairo, in an urban location in a 70-year-old building that used to be a government hub, and the first Moxie by Marriott in downtown Cairo, catering to the 3- and 4-star design lifestyle segments. So to sum up, we are owners and developers of hotels that usually act as a landlord and an enabler to create partnerships with like-minded private sector investors.
Great. Thank you for that. Let's bring on Rishabh to the screen here.
Hello, everyone. Thank you for joining. My name is Rish. I work with the AHIF Middle East and Africa team. And the primary goal or the purpose, as Stephen explained, is we evaluate hotel projects or hospitality-dominated developments. And we look to add value to all stakeholders, in particular owner groups and investors. And look forward to the discussion.
Thank you. And last, Marc. We'll bring Marc to, there we go. Now we got everybody together in one box. Marc, tell us a little bit about yourself, your company, and what roles you play in the hospitality sector.
Hi, everyone. I'm the founder and CEO of the Capital Hotels and Apartments in South Africa, which is a developer, owner, and operator in country in South Africa. It's a business that's 14 or 15 years old. We like to think ourselves as a bit of a disruptor in the South African market for 2 reasons. One is that we have the branded apartments or residence angle to our portfolio. And 2 is, as a developer, owner, and operator through all those verticals, it's quite unique in the South African context, with a strong alignment of interest to break the norms of the hotel sector, which we've done so far. We have 12 hotels in our portfolio, ranging from business hotels to leisure hotels, and they're all across the country: Johannesburg, Pretoria, Durban, Ballito, Mbombela, which is Nelspruit, and of course Cape Town, which we know is booming.
Okay, thank you, Marc. So those are our panelists. We're going to get to panelist discussions soon, where they're going to share some of their stories, which provide some great learning opportunities for us all. But before we get to that, we're going to provide a little bit of just macro context to Africa. And Rishabh is going to cover that for the next few minutes. So we had a number of questions just related to within Africa itself. People want to get an understanding or perspective on which one of the countries or markets seem to have performed very well recently. Which ones do we expect there to be growth in the near term? What are the quote up and coming countries that we should be looking at? And Rishabh created a nice, colorful slide here to help provide a little bit of situational awareness. And certainly we can share this slide with you all afterwards. But Rishabh, can you take a few minutes to talk about this?
Thanks, Stephen. So yeah, I think the hottest question we get asked is where to invest, and I thought it's better to answer the question with some context and a framework. We come across investors from different types of investors who are private equity or institutional investors, family offices. So I think there's some background noise. Okay, I hope I'm audible to everyone. So I mean, if you look at the map of Africa itself, I've tried to classify the more mature markets that have a lot of hospitality and tourism infrastructure. So the darker green markets, portray some of those, traits. Egypt is by far the biggest hotel market, 170,000 keys, really good source markets, visitation of over 15 million in 2023. And then, South Africa, Morocco, and Tunisia, have 60 to 90,000 keys. Of course, this is all organized space. There is a lot of unbranded supply in all of these markets. But I think those four are, definitely head and shoulders above the rest. The East African markets, and along with Nigeria and Ghana, have about 15 to 20,000 organized rooms on an average. And I must not forget Mauritius as well as one of the bigger markets in the Indian Ocean. And I think the darker countries are where we receive most of the investor interest inquiries for. Each of these markets are, of course, individual, have their own nuances. The second shade, which covers most of the continent, is the middle green, is markets that have about 1,000 to 10,000 keys. Still very limited considering some of these are major political and economic hubs or capitals. And then there is the light green shade, which has less than 1,000 keys. So ample opportunities. It's just that a lot of our international investors are more risk averse as far as country risk is concerned, and the smaller markets or the less mature markets are more suited to regional investors. It's not to say that they don't have opportunities. I think it's just about the framework in which you make that decision. The second part I want to kind of speak to is the number of variables you have to deal in African markets, especially the ones that are in early stages of development. If you can look at the RevPAR growth over the 4-year period, if you look at the delta between the green and the blue numbers, Cairo and Accra have seen really big deltas because of the devaluation of the currencies. But it's still really impressive growth, considering we lost 2 years to the pandemic, and this is a compounded annual growth rate over 4 years. Seychelles, on the other hand, is a more stable country. The delta is not very big between the local currency and the US dollar, and has high barriers to entry. I think it's going to see some short-term supply. South Africa is a very different market. It's a very unique market. There is not a whole lot happening in the pipeline. The country is also not growing as fast as some of the other economies in Africa. So most of these countries that are highlighted in darker shade of green are growing at more or less at 5.5% over the next 4 or 5 years in terms of GDP growth. Senegal, Cote d'Ivoire are growing at even faster rates, more than 6%. So there's a lot of activity there. South Africa doesn't seem to have that, but what it has going for itself is a really good financial market. The banking sector is really established. The legal framework is there. So it's a committed market, and Cape Town, as Marc mentioned, is booming and is on a lot of people's wish list to have an asset there. So I mean, what I'm trying to say here is that there's a lot of opportunity, and I think every investor who's looking at Africa, must use a framework. And my suggestion is that framework consists of 3 filters. One is the country risk, and the country potential. A regional sovereign fund will have a different risk propensity to invest, around that region, whereas an international investor, it may not appeal to them. And then the second is hotel market dynamics, what the supply looks like. So if you look at Ghana and Kenya, they have a lot of hotels, in the supply pipeline. So same goes for Ethiopia. Of course, a lot of the supply may not materialize, but that needs to be investigated vis-a-vis your holding period, and what risks that carries. And the third filter I would say is micro market or asset level assessment, to see where you're located. So a Cape Town city hotel, a CBD is not necessarily the best location. You might want to look at a mixed-use development to kind of balance out your risks. It really depends on whether it's an acquisition strategy to reposition it or not. And I think that framework where you go, filter it by country risk, and you filter it by market cycle and your holding period, and third by individual site assessments or project assessments, I think is a good way for you to understand your risks appetite. The hot markets, I think that's also a big question asked. I think a lot of the mature markets are seeing a lot of experiential leisure development. I think those are good projects to look at. I think Ömer mentioned some of them. Urban regeneration is the second category. So a lot of these assets or buildings are about 30 to 40 years old, in some cases higher. So there's a real opportunity to reposition, repurpose, rebuild some of these into the more relevant 2020 style of live, work, play. And I think the third one, which has always kind of been close to the heart and very important to Africa, is the safari segment. And I remember in 2020 when we were going through the pandemic and looking at all sorts of models for recovery, the one segment that was really confident of recovery before 2023 was the African safaris. And it just speaks to the kind of demand there is and the interest there is. And I mean, they were the first to recover. And even though they are the least accessible places sometimes, and it's great to see, the Mara Serengeti system finally getting the kind of occupancies that they should have. And yeah, I think Matt asked me this question a year ago, where I would put my money, and I would still say if you have the vision and the capacity to hold long term, it has some great returns. So yeah, that's in a nutshell. I think it's difficult to compare countries, but I think that's my framework to evaluate investment potential.
All right, thank you, Rishabh, for that overview. And I think it's probably pretty safe to say too, for those out there who are evaluating the build versus buy, if you're looking to buy someplace in that light green country, there's probably not a lot of options there. Okay, let's go to the next slide here. There's a number of questions related to what other type of yields are we seeing for the lending rates that are done, and clearly there's going to be a lot of variability within the African continent, and even within a country itself, depending upon what type of positioning the hotel has and the type of hotel and everything else. There's going to be quite a lot of variance, but we did put some numbers here just to provide some perspective and context. We do this all over the world, as I mentioned earlier, so I provided some context in other areas of the world, Europe, the United States, GCC countries. And Rish, can you take a minute or two at the most to maybe cover some of the African related data points here?
Sure. So yeah, I mean, it's a very broad range for the African continent, just because of the number of different economies that we're dealing with. I think just to give you an example, the more mature markets, as we mentioned, Egypt, Morocco, Cape Town, high infrastructure, a lot of tourist footfall. The financial markets are more mature to lend about 60% loan to value. Of course, in the pandemic, this ratio was skewed upwards. I think interest rates are always a topic. I think you need to evaluate all lending criteria in total, but broadly speaking, those are the interest rates between 8 and 9% that you could get. Egypt currently is a difficult story, and I think we'll speak more about financing and the challenges of financing.
Can you all present someone's? Thank you.
And then, I think mature markets equity yield expectations are around 15-16%, but as you go to those middle green countries, it starts increasing, and in extreme cases, it can be upwards of 20-22% as well. Cap rates are always a topic of discussion for hotels. Generally speaking, and we could have a different session on this altogether, but there is not enough evidence.
Hey, Rich, hold on. I don't. Are you guys hearing noises?
Yes.
I don't. This is not. We gotta resolve this.
Yeah.
Okay.
Mala, is it possible for us to mute everyone except for the speaker? Perhaps maybe that would help.
Yeah.
Yeah, you should be fine now. Let's see, I've muted everyone else.
Okay, thank you.
All right, Rish, I'm giving you 1 minute. We gotta move on here.
Yeah. Now, I was just saying cap rates are really difficult, and during the pandemic, we saw some really low cap rates. I think it's you have to evaluate each market and each asset and look at those elements. So yeah, I think that's it, and we can move on.
Okay. Thank you, and sorry for that disruption here. We'll now go on to our more of the panelists. Sorry, more of the questions that you've submitted. Let's Marc, I'm teeing this one up for you. Number of questions related to building versus buying, and I know that that's something that you and your business has think about regularly. And what are you currently doing in regards to that when you're evaluating the deal? How do you evaluate the trade-offs of building versus buying? And let's just start from there.
So our portfolio of 12 hotels across South Africa, half of them are built by ourselves as developer, and about half have been bought brownfields acquisitions. 2 acquisitions we did recently. One is a Fairmont Hotel in Ballito on the coast, leisure and incentive travel hotel that got into business rescue, and then a Marriott, high-end Marriott in Cape Town called 15 on Orange. And I can tell you they were very successful acquisitions. We did refurb them, and they were very successful acquisitions. But the return on hassle, the return on headspace, particularly in the context of Africa, should not be taken lightly. We got amazing bank funding on the acquisition, but then had to put in for the refurb basically all equity, because the banks took a very conservative view on the refurb. In addition to that, we have had very old air conditioning systems in coastal areas. We've had very inefficient, call it non-green, old world type technology that continues to be very expensive to repair and maintain and to operate. And even though they're successful acquisitions, the return on equity as a result of this and the return on hassle has not necessarily been as wonderful as, for example, the Capital Bombela that we built in Nelspruit, which we built in the same period 2 years ago, where we built towards a blueprint. It's the Capital, what we call standard model blueprint, and I probably have had to attend that hotel from development and operation probably 15 times now, a flight to Bombela, versus going to Zimbabwe probably 100 times to get things right. So in the context of Africa, you've also got to work on what's the return on hassle and the return on equity of a new build, the ability to have it as a standardized model, something that's efficient, green. I can tell you right now is something we're chasing. And so our goal as a business now is much more about land acquisition, zoning, and then trying to build out our standard model all across secondary cities in South Africa. It's a good time to buy sites. It's obviously a good time to do distressed acquisitions. It's post-COVID, but it's a particularly good time to buy sites. So our view is, believe it or not, contrary to most, and always depends on price, of course, but it's when no one else is building any new modern stock, this is the time to build new modern stock.
All right, thank you for that, Marc. So you've got the trade-off, right? You buy an existing hotel, you can have presence in that market immediately. You can theoretically have some cash flow immediately as well. However, there's a lot of unknowns as far as once acquired, making those renovations, doing those PIPs, and then getting help to actually complete that. It sounds like there's a lot of things that you just really can't account for from a costing perspective and from a timing perspective. Is that fair? Versus if you do a lot of development, you might have a team in place, you have systems in place. It will take, clearly the timeline will be a lot longer than an existing property. However, your point, return on hassle is a lot less. Is that a fair summarization of everything?
Yeah, that's a very good summary. And, I think the one point that's maybe just missed that I could reiterate in terms of that summary is that at the end of the day, what is a long-term investment in Africa? If you think about it, that 1 year, 1.5 additional years of being able to buy and operate quickly in the grand scheme of your African investment, which should be long-term, it shouldn't necessarily matter.
Sure. And to take that remark a little step further, do you have a particular type of holding period strategy in your investments? What's your time horizon generally when it comes to your investment strategy?
Our time horizon is indefinite. We're a developer for our own stock. These are keys that we operate well above market because of the synergy, like I said earlier, of being a developer, owner, and operator. We take a lot of kind of frills and ego and some nuisance that seems to creep into the hotel sector. We take that out. And so we'll end up having a product that's a below market cost per key, which gives us kind of a first loss protection, gives our banks, our financiers first loss protection. It yields very well because we operate above market. And so for us, it would therefore be an indefinite holding. And our objective is to continue opening 2 to 3 new hotels a year, adding to the portfolio, adding to the synergies of scale.
Okay. And it sounds like most of those will be new builds based upon your experience. I'm just out of curiosity on that example that you gave, how much of a delta was there between when you underwrote it before acquisition, those improvements, those renovations that you wanted to make post acquisition? How close did you come to budget on that, or how much did you go over budget? Is probably a better way to put it.
Look at our hotel 15 on Orange in Cape Town. We knew quite accurately what we wanted to do, and the renovation was limited. And so there we were exactly on budget, and it was fully financed. But you take a Fairmont hotel, 24,000 square meters of GLA, a resort is really what it is. And you throw us in the midst of COVID as well, where, as an example, in that period, there was supply chain blockades happening, both internationally. We know there was the shipping crisis, Then we have transport logistics on road in South Africa. Roads got blocked with riots breaking out. These are some of the African stories, unfortunately. All of that led to quite significant overruns, and we knew it was a property we couldn't really overcapitalize. It was a fantastic property, and it's turned out to be same. So we landed up almost building it based on the cash flow we were generating as we came out of COVID. As more and more cash flow came in, we almost put it in the property, but that's a very inefficient way of doing it. So the delta was probably in the region of as much as probably 14%, if I recall, or above budget. And of course, that all had to then be equity funded. So Africa is not for sissies when it comes to any builds, but also to renovations in particular.
Okay, Africa is not for sissies. That's a very succinct and accurate representation perspective there. So thank you on that. But you also teed up to one of the other questions here on the slide, and that relates to dealing with when you have to make any sort of capital improvements. Most likely, you're going to have to import some material and FF&E and so forth. South Africa maybe a little bit less so than some other countries, but how has your experience been with that? And once again, you're just focused on South Africa, so it's a good, it's just a data model for that country. But how has that been going for you historically, and has it gotten better or worse in more recent times?
Yeah, in South Africa, that's not really an issue. We once looked at, from a cost perspective, importing goods manufactured in China. We're talking about FF&E, OS&E. And, you get into that risk scenario where all you need is one item within that hotel to not make its delivery date, and that can stop the whole hotel from opening. And you can land up carrying a far higher opportunity loss and interest expense compared to the gain and saving on importation. So I guess it depends on the horizon length. And I know on this call there's probably quite a lot of turnkey furniture operators who may even guarantee that and the installation be on time. Africa's not for sissies. So like I've said, I think one has to play that relatively carefully about optimizing every cent. We prefer generally to go local. We've trusted our local partners, and they've taken that risk, and thankfully no issue at all from our side.
Okay, thank you for that. All right, we're gonna go on to the next slide here. A lot of questions related to financing. And more specifically, how do I get my project financed? And we can certainly involve our other panelists here who have experience with this. If anyone wants to chime in and share a story, but yeah, I got the sense from the questions from the people who are submitting, there are a lot of people who have never invested in Africa, and they're just curious on how it all works and how do you find what's the best way to get someone to finance a project. And who'd like to handle this question?
South Africa, but maybe someone wants to go first for.
Yeah. Khalil, would you like to?
Yeah.
Happy to cover the Egyptian story.
Oh, okay. Let's start with that. Thank you.
Okay, very well. So yes, we have recently seen very big interest from either DFIs, development financial institutions in our market, or even the conventional banks. There's a lot of M&A happening in the hospitality avenue, which is encouraging private equities to be investing or co-investing in hospitality-related activities for one simple reason, that despite the fact that Africa or Egypt has a very cyclical hospitality industry, but on the medium and long term, investors saw that exit yields are very lucrative, with EBITDA multiples exceeding 13 and 14 times So basically, we have strong appetite from local banks in Egypt to fund. Of course, we have the interest rate, the high interest rate challenge as we speak, but DFIs are very interested into funding in USD and EUR, which entails lower interest rates, of course. And given the nature of the industry and that there isn't any currency mismatch between the revenues produced and the debt service, I think that it is safe to say that you can seek DFI financing. And as we all may know, again, the interest rate differential is usually very cyclical. So we should be seeing cycles whereby interest rates are going to be lower. And again, and I tend to defer a bit to the old report, our equity IRR is mostly exceeding 20%. So basically the high IRR, high returns we are achieving is somehow makes it okay given the current interest rate environment. So this is the Egyptian story. I don't know about other locations, but I think it somehow applies more or less on the whole continent. So again, Marc, I agree, Africa is not for sissies, and this is where the higher the risk entails higher returns, of course, in a virgin untapped market that has huge supply and demand gaps all across the different sectors, from 1, 2, 3, 4, 5 stars, design, lifestyle, experiential, excursion tourism, religious, etc. So I think the diversity of the offering makes it very encouraging for new investments in the continent. Thank you.
All right, thank you for that. Khalil, you have a little bit of experience of this. We like to share some of your wisdom and maybe a story or two about the financing process for somebody who's new at this.
Look, thank you very much, Amr. I fully agree about let's say your description about the Egyptian situation market. I think that we need to put aside some, let's say, sophisticated market like Egypt, Morocco, and Southern Africa, because they do have a local banking system which is pretty much sophisticated, liquid, in local currency. So it's very much helpful to secure funding for sizable hospitality assets. Also, these kind of countries, they are extremely attractive to DFIs. And even in some cases, we could even structure funding more competitive than what DFIs and multilaterals could provide to us. And specifically, if I'm taking the example of the Moroccan opportunities that we've been working on. So unfortunately, in Africa, we do have 54 markets and not one single market. So if we take in this north and southern region, all the sub-Saharan region has a pretty much challenging story when it comes to secure funding, and specifically when it comes to long run assets, either in infrastructure or in hospitality is the same, because as Marc has mentioned, when we go into an hotel, it's a long-term run. It's not just to make a trade or for 2 or 3 years. It's a greenfield one. We have a 3 years period of construction, then many years of operation before expecting to get a decent payback. So when it comes to sub-Saharan region, we should provide some nuances when it comes to the challenge to get to the financing. But at the end of the day, DFIs or commercial banks are, let's say, willing to look to and to support hospitality's project in this region, provided that we are dealing with one sophisticated developer, people who are willing to invest some money into the development cost to go from an idea to a business case or bankable case. And that makes also important to, I had a story with one of my clients who in West Africa who has just exited from an oil field. So he made quite good money on exiting on this block. And we having dinner. I said, look, Khalil, I want to invest this money into hotel. What do you think? I say, okay, hospitality business, it's another industry. No, I need to have my own hotel. I'm done with going to the Sheraton and Marriott. I need to have my own hotel. I say, okay, fine. So let's work on it. My first question was, okay, how much money do you want to put on the table to work on the feasibility study? Say, well, 5,000-10,000 K. Say, look, no, this is not the way we could look at it. We need absolutely, when it comes to individual or high net worth individuals, I'm not talking about institutional because it is part of their DNA, but in some sponsors in Africa needs to have the mindset of, let's say, investing some money in a very early stage to mitigate the old risk, to make it easy story to sell to lenders and to equity providers. So that's why every time I had the opportunity to talk about financing, I'm saying, look, financing is the output, but the input, we need to invest more money and mitigate the whole risks to make sure that the case is something that will be easy to sell to lenders and equity. So we need to make sure that if you are international investors locally, we need to work with the strategic partnerships, collaborating with local partners as a real estate developer, hospitality management company, or government agencies can help very much in navigating the regulatory challenges and so on. Second point, which is very key, and I couldn't highlight more on this element, is we need absolutely to work on how to mitigate the whole risk, mid-risk. So we need absolutely to implement a full due diligence set, comprehensive market studies, and that was I was saying we need to invest some money into some international professional providers to help us to assess the commercial risk, the market's risk in terms of supply, demand, what is the good position that we need to put into that market, the capacity to absorb the pricing and so on. And this is very important that would help to mitigate the uncertainties associated with changing landscape. Other point also, I think that the last thing that people are, I mean, it depends on how sophisticated you are, but relying on the brand partnership and franchise agreement is something extremely key, because it's becoming a must to have from the lending or equity funding perspective. So we need to collaborate with international hotel brands through franchise agreement or management contracts. It would also enhance the attractiveness of the hotel project as a whole and for the investors as well. And so also this is something that it's becoming very standard, but when we deal with some let's say local sponsor, it's a curve that we are crossing, but now it's becoming everywhere a standard. So this kind of things we need to work on a very early stage to ease the story when we're discussing with lenders and bankers. Now, for sub-Saharan Sahara, in some cases in West African countries, it's a bit challenging for commercial banks because the way or the banking system is structured, they are struggling to get beyond 7 years door-to-door tenors. So we need to put some enhancement in terms of the structure, some guarantees to go beyond this period to a longer tenor. The problem is this kind of enhancement structuring would cost a bit of money. It potentially would hit also the return of the developers. That's why people like DFIs and multilaterals are key in this area. In other areas in East Africa, in some countries, commercial banks are pretty much liquid, and they could fund a loan without the support of any DFI. So it depends on each market, but globally, a mix of commercial markets in DFIs and MDBs is something that would help this hospitality to get to a, let's say, to a stage whereby international investors will be looking now to Africa as a real destination in terms of hospitality, because the demand is there. But we need just to make sure that we have an appropriate supply, run and build and management under international standard.
That was excellent. Thank you. So, yeah, a question that I get often from people is someone will approach me and say, "Hey, Stephen, I've got this. We don't need that slide. We can go keep. You can take the slide down. Thank you. We've got this great plot of land. I think it would be perfect for a hotel. I'd love to build and develop it. Love to do it, but obviously I'm going to need financing to get this done. How do I move this forward?" And one of the things that you've just described, Khalil, was you really want to build. Well, if you're a reputable developer, first step, that certainly helps a bunch. But you're really building the business case, a strong business case in advance before approaching any lenders, and that is just acknowledging what the potential risks are and how you're going to potentially mitigate them. Getting a feasibility study done by a third party, and by a credible third party, something that will have a recognizable brand name, as opposed to someone who is not very well known. And then obviously having an association with a recognizable brand or management company will de-risk the situation as well. But then you also mentioned sort of implicitly that if there is risk there, or if you want to further de-risk it, putting in guarantees will help de-risk it a bit. And in markets where there's less liquidity, that might be more necessary to include, to make it more attracting to lenders. Does that summarize it?
It's a fair summary. Thank you very much.
Okay, perfect. Marc, I don't know, you're probably a little bit different than the example that I gave, because I gave the example of someone's not in the business, they've got a plot of land, they need some help. How does everything that I've shared and that Khalil has shared resonate in your world as a more experienced developer? And what sort of challenges have you faced with getting financing? I mean, you mentioned you had to do some renovations and PIPs, and the banks didn't want to lend you additional money for theirs. You mentioned that as an example previously. Is there any sort of other examples that you might be able to share with us, and maybe the challenges or what has worked well for you in getting financing in South Africa?
So the debt markets in South Africa are deep, as described earlier, but they're risk averse. And so I was that person 14 years ago who didn't have a track record and had an idea. And I can tell you, when we went to banks on the back of our first acquisition, which seemed like a no-brainer to me, it was at a time where the banking system had some oversupply with the 2010 World Cup soccer having left South Africa. And quite a lot of banks took some hits from the simultaneous development of hotels for the World Cup, and of course, not sustainable, leaving quite a big supply overhang. So the hotel word in the credit committees of the big banks in South Africa was a swear word, just at the time where we saw some unbelievable distressed acquisitions and the like. And so the answer there was a private equity partner who could come in, help us, who could see the risk return as described earlier. The returns, Africa is not for sissies, but when you get it right, wow, the returns are absolutely fantastic. And sometimes it just takes an equity partner who can hold your hand in the beginning. And then, as we built up and built our track record, the funding got easier and easier from each step. But in 2017, 2019, maybe 2018, 8 years after the World Cup left South Africa. I'd say that's the time when banks finally started lending again to hotels. And we're talking about those 50% kind of LTVs that you're describing. It's not as if we're talking about funding at 70, 80%. We're talking about still conservative funding, but they wouldn't fund till 2017, 2018. And then what happened? COVID. And the banks have potentially taken some knocks again. So hotels continue to be swear words in the banking system. But for those that have the track record, those that have got the equity checks, those who have got maybe the hand holding of a private equity partner, then all the banks kind of congregate towards them. So, and in this example, we're one of them, thankfully, because the banks have got to deploy it, and they love if they can see a good deployment. What they're finding at the moment is that in this hyperinflation environment that we're in, the hotels are able to price their property and adjust it immediately through their RevPAR management. Whereas, we know with commercial property and retail and the like, it's all on long-term leases. So if you get it right and the banks become your friends, they're your best friends. But it takes time to build that track record.
All right. Thank you. That's great. So find a good alliance partner to get you started, and that certainly helps build your reputation and brand and track record with the banks. Okay, let's go on to the next set of slides. And Amr, I'm going to tee you up here for a question. Get you back in the fold here. We got a question. These are geographically specific questions that people have submitted. And since you're probably the Egypt expert here, the question about how in Cairo, what's going on with the large inventory developing, and I'll add my own little twist to that if you're comfortable answering it. Do you think that there's still opportunities within Cairo because there is a large amount of inventory developing? So what's going on? What's happening there?
Sure, that's Stephen. So basically, if you would analyze the Cairo market, as many of you may know, Cairo has expanded further east and west. So the new city or the new urban community towards the east is towards the new capital, and there's another extension towards Sheikh Zayed and 6th of October city. So basically, those new cities have their own demand, one of which, the western one, is more tourism oriented, because this is where the Pyramids Plateau area is. The one towards the east is more the corporate type of offering that still is associated with having the new capital on that side and the main airport. So basically, and the Ministry of Tourism has performed a study, a thorough one, on opportunities in Cairo that yielded the fact that we need abundance of 6,000 hotel rooms within the coming 2 years. Because basically most of the new inventory came in the new urban communities, but nothing much within the downtown area that has the historic significance, the River Nile and the old Egyptian museum that is still attracting a lot of tourists, especially the GCC tourists that come due to the uniqueness of this offering, as opposed to the new urban communities that are replicas of basically GCC normal cities. So there is demand for further inventory. We had focused because basically if the downtown area has 20,000 hotel rooms, 11,000 of which are luxury 5-star properties overlooking the riverfront. But where is the design, lifestyle, experiential type of tourism? Where is the 4 stars, 3 stars with flags? This we don't have. So basically there's a huge supply and demand gap into segments that are not 5 stars waterfront hotels. We've been experiencing a big wave of boutique hotels, themed hotels in the downtown area, capitalizing on the architectural heritage that is basically Italian and Belgian and French. Of course, some of the buildings are British origin. So again, this blend or this fusion of cultures in downtown Cairo and the authenticity of the offering makes it very unique for a lot of tourists. So still, yes, we do have future inventory in the pipeline, but the city center is still way away, with imminent demand of 6K rooms within the coming 2 years. We've been seeing, and of course, HVS that are very rigid and big partners to us, have always fed us with information that entailed that we are exceeding 80% of occupancy, give or take, the past 2 years with very high ADRs on 5-star hotels. This dictates that we need to increase somehow the offering to meet future aggressive demand. I hope I answered the question.
No, I think you do. So it sounds like the real opportunity there is like in the 3 to 4 star space, which is not being fully met right now. And your thinking is that it will induce demand that doesn't otherwise exist in the marketplace, just because the supply has largely been on the luxury 5-star segment. And so with that sort of logic, you're probably not too concerned about an oversupply within Egypt, because it won't be causing an oversupply from the induced demand that it will be creating.
Certainly not, Stephen. And we've been also seeing I would call them the new prop tech, type of offerings that entail serviced apartments, Airbnb, in an organized manner. So we have 3 or 4 startups in that avenue that have altogether north of 5,000 keys within the city center. So again, this dictates that still the supply and demand gap is very high. We need to focus on the 3 and 4 star offerings. Also, design lifestyle or lifestyle offering is something that is of very high demand and extremely underserved in the market as such.
Okay, great. Thank you for that. We have another geography question going a little south on this. Says the Kenyan coast. We're not able to attract global names in the Kenyan coast. What needs to change? Especially there's the whole concept of beach to bush or bush to beach, where you do a safari and you finish your safari on the beach. I know Tanzania has done that. I've actually done that as well as Kenya. And to my recollection, there's not much, or if any, real international brands on the Kenyan coast. So who wants to talk to that? Rishabh, that's probably a question for you. Is that fair?
Yeah, happy to take it. I mean, it's an interesting question, and I wonder what the root cause of having global brands means. But I think it's a matter of time. I mean, Nairobi hadn't seen a lot of international brands. We've seen a proliferation of big international brands coming to Nairobi. JW's seen presence in Masai Mara. It's practically broken the traditional safari model in terms of distribution. And I think there is more interest. I think Mombasa and we've done a few projects in Watamu, Kilifi, and we must remember that these were traditionally European markets or European destinations in the 80s and 90s as they developed. And with certain events, it's now become a more regional hub. There's still good hotels there. I think we've looked at a few projects where, as Marc said, the return on hassle of taking a 30 or 40-year-old resort and reconverting it are significant, and investors have made the plunge. My sense is that it would have to be a East African private entrepreneur who would take the plunge in putting up a product that's significantly superior and needs an international flag, and perhaps towards more of the South Coast. It has to be more exclusive. You have a really hot destination like Zanzibar competing, and we're seeing more signings happening in Zanzibar with international investors and brands. So I think it's a matter of time how that system develops. But just thinking about South Africa and how the beach and bush experience developed, it was mostly through regional players or domestic players that kind of launched that. So I think before international brands come in, it kind of has to be certain regeneration and upliftment of the destination and access, generally speaking. And I think the brands will generally come there.
Yeah, I mostly agree with you there. And I think you got to get Nairobi really set up as the as the initial market, because everyone going to Kenya is probably going through Nairobi. And once you get that establishment in place, it's a lot easier to sort of build the brand awareness to the coast as well. Okay, great. Thank you for that. We also have a question here in Mauritius. What are some of the advantages and limitations of investing in Mauritius compared to other Indian Ocean nations? And Rish, I guess this is probably a question for you as well. If you can keep this nice and brief, that would be great.
Yeah, I mean, the advantages are, there. It's good infrastructure already there, good airlift. It's one of the biggest Indian Ocean markets. I think, we've seen a very high, recovery. 2022 was slower, but 2023, we've seen a marked recovery. It's back to that 70% occupancy range. So a lot of advantages in terms of, tax structures and the ease of doing business. I imagine the only, disadvantage is, or a question is, all Indian Ocean islands have high development costs, but also considering that a lot of, leisure is moving towards luxury and exclusivity, and we haven't, it's Mauritius doesn't compete in the same price bracket as a Maldives or a Seychelles does. So it's about, how does the destination reinvent itself in terms of experiential luxury leisure. And I think we've seen some exciting projects more inland, capturing the experience rather than just focusing on the beach and the ocean life. But yeah, I think that's how I would say Mauritius is.
Great, thank you. So positive tax structure, the downfall is the downside. Some limitations or challenges, high development costs, and you might not get as good. You're probably not going to get the high rates as you have in the Maldives, at least as it currently stands. And then last geographic question here, Ethiopia. Rish, I guess it's probably for you as well. Keep it nice and brief.
I don't know how to make this one brief, because Ethiopia has very really high potential. It's one of those markets that was a rising star, pre-pandemic. Really great northern circuit, really great tourism potential, a big expat community. My sense is, I think if the question is more in terms of investment, I think there needs to be a more transparent system. Ethiopia is very unique in terms of its historical progression, and it literally operates in its own time. But and this is not for Ethiopia, but for all markets in general. I think the greater transparency there is to a market, the greater confidence there is in a market, and investors and lenders and all. And South Africa has gone through this, process over the last 2 decades. Like Marc said, after 2020, the banks kind of shied away from hotel investments, but it's taken some education to bring them to see the benefits. It may be at a lower LTV, but I think there's a lot more transparency in the South African market, and that kind of helps. And yeah, I think Ethiopia is generally, a very high interest market, but we've seen a pipeline of 5,000 keys in Ethiopia for a very long time, and a lot of them are shells standing, not really getting converted. A lot of them have the local capacity to construct the hotels, but not enough hard currency to furnish and get it going. So the intent, the scope, and it has to be better organized.
If you allow me, I will just add one thing on Ethiopia. I fully agree. Ethiopia is one of my favorite African market in terms of potential. You just take all the industries in Ethiopia, tick mostly all the boxes in terms of demand. Now when it comes to how to structure a deal into the hospitality, we have 2 challenges there. which also there are also challenges to other businesses when it comes to foreign funding. If you need to the local capital market is, let's say, pretty much liquid in local currency. But for the hotel business specifically, you're gonna have huge challenges in two things. If you need to import things and buy all the equipment in hard currency, it's a bit challenging. Second thing, when you discuss and when you negotiate with hotel management operators, usually these guys are need to be paid in hard currencies, and that aspect is pretty much tough now because Ethiopia is facing some challenges in terms of availability of hard currency, and even though they have some USD resources, they are allocated in priority to some strategic, let's say, expenses such as oil, medicine, and so on. So when you go with the demand to the National Bank of Ethiopia to pay 500K to Marriott or to Sheraton, you're gonna wait for a while. So this thing, it seems very, let's say, limited in terms of impact, but to close your deal or to have a continuous support from your international service provider or equipment provider, it's a bit challenging to deal with for the time being in Ethiopia. I'm focusing, saying for the time being. Well, it's been for a while. We hope that Ethiopia will go through this in the next years. But for the long run, it's the fundamentals, the market are great. That's my experience in Ethiopia.
Okay. Thank you for sharing that. I actually have a question here submitted by one of the participants. It says, question to Khalil and Amr. How can property owners in Egypt plan budgets and forecast revenues with the continued increased inflation and Forex obstacle? Good question.
I leave the floor to Amr.
Amr, you're on mute.
Sorry for that. That's actually an amazing question. So basically, a lot of investors see the only hedge for Egypt's inflation is to invest in hospitality, because basically you get, of course, higher inflation rates are usually associated with a fluctuating FX environment. So basically, the more the fluctuation in inflation, the more there is devaluation for the currency. So basically, you're never caught on the wrong side. So again, the FX gains investors in the hospitality avenue made in the past 3-4 years defies the double-digit inflation for sure, comfortably. So that's the simple question. Everyone sees the best hedge for inflation is either investing in FX tools or in hospitality that is an FX-dominated investment.
Yeah, someone shared to me that the hospitality industry is the best form of real estate in a high inflation environment because of the daily leases. And yeah, all right. Great. Have some other questions here, some odds and ends. And once again, you can submit the questions. And actually, we're going to try to wrap this up in 10 minutes. So this might be a little bit of a speed round. But let's take a look here. Someone asks, is there a play for limited service development really in Africa? If so, what countries are best positioned and which flags are best suited? Now, it's a very broad question, but maybe you could change the focus there again. Maybe there's a shared experience one of you can provide there as far as experience in dealing with limited service. At least when it comes to branded hotels, just my life experience and so forth has been in developing markets. They usually start off with full service luxury, and then it slowly works its way down the chain scale. Yeah, thoughts on limited service development, and whoever is in charge of the screen here, if you can put us back on our faces, back up. Perfect. Thank you.
So I mean, my take on limited service is, similar. More mature markets are likely to have more potential. I think developing markets, you're basically, I think the better question to ask is, how do you scale limited service hotels? Because you need 30, 40 more hotels for it to start making sense, and that opportunity only exists in larger, more mature markets.
Okay, thank you for that. Marc, do you have an opinion on this?
Again, I can provide the South African context only, where we're seeing limited service hotels in city centers, the bigger cities, and the minute we go into some of the outlying areas where our objective now is to build our new hotels in secondary cities. They're still quite big cities. They have malls. We could get away with limited service, but what we're finding is that the average traveler that comes into these cities needs trust, and trust means full service in the context of hotels.
No, good point.
I think brands would have to tweak their service offering to become more select service, especially, it's very characteristic of developing markets.
I have another question here. What is the average market yield for a hotel investment in Mauritius from an investor's perspective? So what are people underwriting for their yield requirements to make an investment feasible in Mauritius? Any thoughts on that?
I would say minimum of 15.
15%?
Yeah, 15 from the equity side.
Okay. Gotcha.
Rishabh, maybe have more feedback on the benchmark that you have been looking to.
Yeah, I think. Yeah, it really becomes tricky when you say typical average, because it kind of, in hospitality, it's a rarity. But yeah, I agree. It would be 15 to 17%. It depends what kind of an investor you are, what your holding period is. If there's an opportunity for you to take over an existing hotel and reposition it, and you're looking at a 5-7 year horizon, you'd want a better yield. On what Marc says is return on hassle. It's interesting. Yeah, let me leave it at that, because I think we have more questions to answer.
Okay, great. Let's see here. I think we've got some questions related to liquidity transactions. There's a question about how does trading volume compare to the rest of the world. That's a big general question, but certainly trading volume is a lot less than it is in the United States. So yeah, liquidity is a challenge. I think that slide that Rishabh gave earlier on, as far as room inventory, room supply in the various countries, will give you sort of an indicator as far as liquidity. Then you also got insight earlier from Marc that he sounds like he doesn't have plans to sell his hotels anytime soon, versus the US, the average holding period is about 7 years. So very, very different perspectives there. Another question related to institutional investors. Where are they and what induces them to be active? Anyone have any thoughts on that? That will be the last question, just to frame things, unless someone pops another question on the screen.
Yeah, I think they're active, all over, maybe more in Northern and South Africa or Southern Africa. Pension funds are quite active. I think what gets them to have more activity is just maturity of the market, more trust, more reliability, more stability in the market. And I think some of them are driven more by, the larger purpose and kind of build to hold kind of thought process, or at least build to hold for a long time. Yeah, that's my take on that.
Same for Egypt here. So we've seen some decent M&As in the hospitality avenue the past year, all driven by GCC funds aspiring to have presence in the growing hospitality market in Egypt. Unfortunately, nothing greenfield. So we're still hopeful that we would see direct investment in greenfield hotels rather than acquisition of brownfield operating assets. What's phenomenal is that we've been seeing a lot of financial investors more than strategic specialized ones out of the GCC funds. So basically, yes, we have decent M&As in the market, but still we don't see a lot of foreign direct investment in the avenue in greenfield properties.
Yeah, I would add on, indeed, GCC investors and sovereign fund out of Qatar, Abu Dhabi, Saudi now are also looking, but to some really specific market, not to the whole African. I think for them, Egypt is an easy story, and given the relationship between the GCC countries and Egypt, it's a natural market where they're investing. Moroccan market is something that they are looking at, but I think local investors are in Morocco also are deep enough to back and support the King vision in terms of developing new assets, and specifically with the Morocco now hosting the World Soccer for the next one. In West Africa and Central West Africa, it's been selective, and I'm seeing two type of investors back in the hotel investment there. Some local pension fund, they are not quite deep, but they are, let's say, big enough to support one single opportunity in Ivory Coast, in Ghana, also in Senegal. But also in DeFis are looking to these countries, and some UK private equity firm. Generally, the private equity firm has a mandate to invest into infrastructure in sub-Saharan Africa, and they are allocating a portion of their assets to real estate / hospitality. And hospitality is taking a bigger portion of it because it's more, in terms of return, is a bit more lucrative than real estate, than pure real estate. So yeah, this kind of investors that we are dealing with, depending on the market in Northwest in East Africa.
Okay, thank you for that. I did lie. I have one more question. I forgot because I would like to close it off that I didn't prepare any of you in advance for. There's one I always like to ask. Should be relatively easy. If you had, and that will close out the webinar before I hand it back to the bench. But I like to ask, if you have $100 million, your own money, you're investing your own $100 million or 100 million euros, whatever currency you want to use. Where would you invest it in Africa? And try to be as specific as possible. And since I've had a little bit of time to think about this, I will say that I would invest $100 million in building a luxury hotel in the winelands of Cape Town. Who wants to go next?
Okay, I think I want a better return on my investment. I will take I think I would spend about 50 million in looking at a Cape Town CBD mixed-use development, primarily hospitality, and I would put the rest into a beach pitch experience, very bespoke boutique not more than 20 keys each, between the Mara Serengeti ecosystem and the east coast of Africa.
Okay, east coast of Africa. All right,
Now
thank
come
you.
to Khalil to finance the rest of the 100 million.
All right.
Look, from my side, I would be more focusing on urban/business positioning. And I would pick up probably Morocco because they do have something big coming in, either Casablanca and Marrakesh, Ivory Coast, Abidjan in the west side, and either Dar es Salaam in the east side. And I will follow Rishabh to Cape Town.
Okay.
From my side, I can tell you Cape Town is a loved city and it's unbelievably busy. So Cape Town lands up being a natural answer, but the reason why it's not my answer is that, Cape Town's a boom or bust city. When it runs hot, it runs very hot. And unfortunately, it's showed time and time again that it goes into heavy over and under supply. And so it's actually quite a high risk investment, and there's some return on ego players who have like $100 million who start trying to compete with you on acquisition. So for us, the more solid, stable investment is to go into deep markets, these secondary cities where there's quite a lot of existing hotels, but they're old. So you just land up putting in something new and winning more than your fair share of the market. And $100 million goes quite a long way as an equity check there, so we could deploy across quite a few cities in that regard.
Very true. Yes. Amar, where would you deploy your $100 million?
You cannot ask Amar because Amar, he has to invest $100 million in Egypt by law.
You can answer it any way you want and as specific as you want.
So hypothetically, if I were to deploy $100 million, and by the way, because we also, as the Sovereign Fund of Egypt, sometimes do equity investment. So again, I think investment in the tourism infrastructure in terms of transportation, low-cost carrier business, private airport concessions is something that, of course, caters to the infrastructure of tourism and not precisely the hotels. Because again, as we are experiencing more tourists and as Egypt has an ambitious plan to expand the number of tourists, to increase the number of tourists to 40 million, again, investment all across the value chain is going to be crucial. So again, transportation, logistics for hospitality and airport services and concessions is something that I would definitely look into.
Okay, good answer. So thank you all for participating on this panel, and those were appreciate that, and thank you to all the participants for your questions. It's very interesting. The last question, there's obviously a lot of opportunities, a lot of perceived opportunities here in Africa, because we all answer this in different ways, right? So that is certainly encouraging, but as Marc said, it's not for sissies. So just be prepared for that. And yeah, thank you, the bench, for hosting. There was a question. I don't know if this was a planted or seeded question, but someone did ask. What is the best way to network with potential investors at the upcoming event in Windhoek? And so with that, I'll hand it over to Mala, I guess, or to Matthew to answer.
I think I'll jump in if that's all right.
Okay.
I'm sure Marla should do a better job, but thank you to Marla and the team for their organisation of this, and thank you to you, Stephen, Khalil, Marc, Rish, and Amir for coming today. It's been a really fascinating discussion. Personally, I think I would invest my money in somewhere which, if the government supported the development of more conferencing And especially in somewhere like Kenya, I think there's a real opportunity for more conferences to take place, and I would be looking at sort of that sort of type of investment for business travelers. But there we go. I won't keep anyone too much longer. To answer the question that was posed there about how to network, obviously, first of all, turn up. The main thing is that you're in the room. Everybody wants to meet. Secondly, get in early, because now I think Marla and the team will be opening up the app for everyone to use, and this has obviously all of the sessions on it, but it also, more importantly, perhaps has all of the attendees that have registered for the event. You can reach out to them, start making appointments, and yada yada yada. It's there for you to use actively and to make contact before the event. And I think at the event is, first of all, if you're new, come and join me in a briefing at the beginning of the event, and I'll tell you how to get most out of it. I'll give you the lay of the land. And then secondly, get involved in absolutely everything that we do. So this obviously includes all of our networking breaks and breakfasts and lunches and receptions that we've got lined up for you. Also the Networking Express, which is a very quick fire swapping of cards and finding out who's in the room, as well as joining maybe some of the other activities as well that we've got coming up during that event, including our charity run in the morning. Don't worry, I won't be running either, but if anybody of you want to join me for a short walk and get some fresh air before the day starts, then please do. So, in fact, if anything, just be there, because the whole 2 or 3 days are a very active networking opportunity. So I hope that gives you a bit of a flavour to what you might expect. I was really, really impressed, and Stephen stole, I think, the headline comment there that Africa isn't for sissies, but it also, to me, it feels like there's a huge amount of opportunity too. So finally, thank you to you all for coming today and for participating and listening. It feels a little bit like the old days of COVID. So let's just move on and get to meet in a month's time. I'll look forward to that. Thank you for coming, and see you shortly.